Welcome to the 26th episode of the Justin Spaulding Show. We've been going for half of a year now, every single week, every Friday, coming to you from our office here in Janesville. And it is June 18th. Time's flying by. We're almost to the 4th of July, and I feel like once it's the 4th of July, then we just like fly through to Christmas. And it's crazy how fast the year goes and time flies. You know, when you're little, it's like, you know how you're little mudding and it seems like 4 days is like an eternity, right? And all of a sudden, like when you get older and older, I guess you're only 18 yet, so it's
weeks go by.
Once you hit like 25, it speeds up even more. Once you hit 30, it speeds up even more. I mean, we're sitting here halfway through the year already, come up on the 4th of July, and the countdown to Christmas is starting soon. It's crazy. Anyways, sent out some stuff yesterday on Instagram. Just wanted to see what people were thinking as far as what topic we should cover or if we should take questions. I had more responses to people just saying, hey, talk about this concept or topic. And a topic that came up over and over again was taxes. We cover it, you know, here and there. I never really talk straight through on it. I'm going to try to get a little bit of a different twist on taxes today. And again, like I'm not an actual accountant, right? So I don't need you to get, these are conceptual talking points, right? In my mindset, it's clear as day of how all this stuff works and interacts with each other to be able to pay as little taxes as possible legally. But some of the very small details, I do not know. So I'm not going to get into the very, very small details. What I'm going to do and what I think is most important for most of you who follow me and the community out there, I think the biggest part is conceptually understanding the ideas, my thought process, and the thought process, and how wealthy and rich think completely different when it comes to money and how taxes are and are taxed differently than the not as wealthy. And so I just want to get into some of these concepts. You know, first off, not all income is treated the same, right? So when you think about types of income, you've got earned income, and then you've got investment and passive income and that other type of income over there that most of the planet doesn't have because it's not talked about. It's not talked about enough. It's not taught in schools, and it's not taught correctly. You know, people are talking about, I was coming into the office this morning. I drove in here. I was left home at like 5:30 a.m. I got to the office like 6. And on the way in on Fox Business News, they were talking about how the host of the show had said, you know, there's more people, and they threw out a percentage of like it's 65% when it used to be 45%, but it's 65% of parents today talk to their kids about money. It used to be 45%, less than 50, so it's, you know, it's going in the right direction where the conversation's actually being had. And they brought on, you know, essentially a banker. And they're talking about all the wrong things about money. It's not what you should actually, they're talking about just saving and, you know, yes, saving is great, but if that's all you're doing is savings, you're still going to end up being hit here, and you're not going to be able to get as much joy out of the capital gains early on in life. And that's what we need to talk about. We need to talk about some of these things. We need to talk about saving to invest, not saving just to save to the end of life. Saving just to save the end of life, from a tax standpoint, you're going to get hammered. But not everyone's talking about that. Not everyone knows. I don't even think it's some of these people's fault who are talking. Now, when you get a banker on there talking about owning your own home and that being an investment, you know, yeah, whether he knows what he's talking about or not, it's the bank's product to pitch you a family, a home, a mortgage, a home mortgage. So they want you buying homes, right? It's not the best investment. If that's the biggest investment you have, we've said it all the time on this show over and over again, it's not going to be pretty for you 20 years from now, 30 years from now, if that's your biggest investment. So not all income is treated the same. Earned income is the one that is hammered the most, and that's where obviously 99%, 100% of people are making money. Yes, we all have to earn income. I have earned income, right, for the time that I'm trading. That's what earned income is. Earned income is a salary, hourly. You need it. I'm not saying you don't need it. We all need it, but it's going to be hit the hardest when it comes to taxes, right? And that's where I'm looking on my screen that I've got in front of me, and it's showing the same thing you guys have. So I took this right off of the sources, the IRS. This was 2020 federal income tax brackets and rates. And on On the left side over here, I've got kind of it shows for singles, it shows for married, and it shows for heads of households. And then what I wanted to do, just to keep it simple for this, is just zoom in on the single, the individuals, just because let's just look at it that way, individually. So when you're going out and trading your time for dollars in your day job, it doesn't matter if you work 40 hours or 60 hours or 80 hours or 120 hours a week. When you're trading that time and getting paid, you're going to be hit with these different taxes. Now, just because you make $1 million doesn't mean the full million is taxed at 37%, right? So the first 9,875 of that, you pay 10% on that. Then from 9,876, you're going to pay that extra 2%. Right, so it's kind of as you make more, you're kind of hitting all of these, but then everything that you make that's $518,000 or more is going to be at 37%, right? Well, there's not many people doing this. There's not many people in the 35%. There's, a lot of the people are in here, right? But you're just getting hammered by taxes. You make $40,000 to $85,000 a year. You're paying out 22% in taxes. The reason I bring up this 22, 24% area is because see that amount of money that you're making there, right? 40,000, 85,000, 85,000 to 163. Those marginal rates on those dollars, you're going to be paying the 22 to 24%. It's taking a pretty big chunk of your valuable time, right? The money that you spent is taking a big chunk of the money you earned for trading your time. And I talk all the time about how my time, I hate even selling an hour of my time for $10,000. So you get hammered here. Capital gains is treated completely different. And what we're going to do is we're going to talk about capital gains, and then we're going to go into even more visuals and me talking about how to get capital gains, more capital gains tax, while you're still having to pay, your earned income tax as well. Look at the capital gains rates now. At the $496,000, for individuals. So here's the chart, right? And then we zoom into individuals again. 0% at $0, 15%, $40,000, 20% to $441,000. So here's the crazy thing about this, right? This is $441,000 and up. So this could be $40 million, and you're still only paying 20%. Go back to the earned income. This is $518,000 or more. You're paying 37%. Look at $441,000. Where's $441,000 here? 35%, 37%. But then all the way down to $40,000, you're paying 22%. So you're paying more trading your time for $40,000. You're paying more in tax than you would in a capital gains event that's over $500,000. This is so much more of an efficient way to be able to get money and keep money working for you, right? You're not having to have as much go out. Don't worry about what. You can talk to me. You're not having to have as much go out for each item. Now, the cool thing about this too, the capital gains, that's your money working for you. So not only on the per dollar are you going to pay less, much less, especially when you start to talk about, $1 million, $2 million, $3 million, $4 million, you're going to pay half the tax. You're also not trading your time for this. So how much more valuable now is that in a dollar sense, from a dollar standpoint, when this is your tax rate on capital gains, it's half, ballpark, and on top of it, you don't have time going towards it. You're getting taxed double on the money that you're earning for trading your time. And I just keep spending so much time on that because time is the most, you talk to anyone that's 80 years old, they're going to trade, any day they would go back and trade with a 20-year-old person. Doesn't matter how much money they have or the situation or whatever, they're going to go back because they would want more time at that point. When you hit 40, you'd love to be able to go back when you're 21, 22. When you're 20, 21, 22, it might not seem like it. You would, because you want more time. Right? Time is so much more valuable. So the goal here is obviously to pay more in capital gains. It's like, well, how do we do that? How do we do it? That's always the question here. Right? something I want to talk about too before we get here is I didn't want to spend too much time and make a slide on it. I try to have as much go through. So when it comes to capital gains can be, real estate. It can be stocks. It can be equity that you have in partnerships and stuff like that, if those were to sell, right? Another tax, when we're talking about tax, another thing that needs to be brought up is how creating a corporation can help lower your taxes and have and how it can benefit you. I try to run as much through my corporations as possible. Why? Because any dollar of income that comes in to me personally is earned income. I'm gonna have to pay tax on that, right? If I'm personally a revenue generating machine and it comes to me personally, any revenue that comes into me is gonna be taxed. If I have a corporation set up, it doesn't matter what my expenses are here. I need a phone, right? When you're a person, you need a phone. Okay, well, you know what? My cell phone is covered by my business. It's ran through my LLC. So what does that mean is my company, my LLC, my corporation has revenue. The revenue comes in, right? And I'm a key player in this, and this is what I do, and I spend a lot of time on my companies, right? My company takes that revenue and pays the cell phone bill. That's a write-off. That will help lower the taxable income. If I make $100,000 personally, full $100,000 ballpark, the full $100,000 is going to be taxed, right? Yes, there's a $1,000 credit here that people get, and there's a $2,500 credit here that people get, whatever. If my company has $100,000 of revenue, and if it pays, $1,200 in cell phone bills, if it pays, we're going out to eat and taking clients out to eat or taking employees out to eat, if it has my, vehicle in there, if it has, whatever, it's going to lower that $100,000. The taxable income for the company is not $100,000. For the company, the company will be able to write off all those expenses. And what is left is the amount that's going to be showing up on my personal tax return, however much I own of that, and then I pay earned income on that. Does that make sense, Maudine? I like having Maudine in the room because he's like learning and soaking all this stuff up, so I can dip by his reaction if it's making sense or not. If it's making sense for him, it's going to be making sense for you guys. Does that make sense, though?
Yeah.
Does that create any questions for you out of the gate? Because if you have questions, that means everyone else has questions.
So
we should just shoot a show with a live audience.
we should put the number somewhere.
Yeah, you can. Yeah. What were you gonna ask though?
Let's say I make $100,000 a year. I have to pay 24% taxes without
Ballpark. Yeah, it'll actually end up being a little less than 24%. Your actual aggregate rate, because you're paying you're only gonna pay 24% on the 15,000, right? Because up to 85,000 you'll pay 22%. Well, anything that was between 40 and 85,000 you pay 22%. Anything that was between 9,000 and 40, does that make sense? So your actual aggregate, whatever they call that, aggregate rate, average rate, whatever, compiled rate would be less than 24%, but it'd be somewhere probably between 20 and 24%, 20 and 23%, or whatever. That makes sense?
Yeah, if I have an LLC, how much do I have to pay? Nothing?
Well, so then that depends, right? So now if you have an LLC, whatever actual taxable income the LLC has, if you're 100% owner in that LLC, whatever taxable income that LLC has, then that will be earned income. But that's after expenses. You got a cell phone bill anyway. If people have cell phone bills, now you have to have a legit corporation that has to be doing something, right? So maybe on the side you can start, maybe on the side, on the weekends, you start going and flipping stuff. Run that through an LLC, you have a business, right? Because you have to show that your LLC, your corporation is actually doing something. Right? So even if you start selling $200 a week, going to garage sales or going to whatever and flipping, and you create an LLC for that little business, the LLC will have, that's where you might have $6,000 of revenue year one, but you could put your cell phone bill in there. And now your little company's paying the cell phone bill, right? It's a write-off. It lowers the taxable amount that your versus before you're using after-tax dollars for that. Right? So that's conceptually, that's the idea. Right? And as that business grows, you're able to put more, like the company needs stuff, it needs infrastructure, it needs to do things, right? You might have, if you're turning around and selling stuff on Amazon, you then just start an Amazon account. So now you're paying your Prime fees and all that stuff through your company. You're not having to pay for it personally. That makes sense? And now your taxable income will go from $6,000, right? Because you have a corporation, you have $1,200 of cell phone bills a month, it goes down to $4,800. You have $20 a month you're paying to Amazon for the monthly Prime or whatever, right? Now it's $240, so it's you're down to $4,600 or whatever like that, versus if it was your own, you're racking up. So a lot of my companies, there's some companies that we strategically have that will be at zero at the end of the year that shows us taxable income, because of the expenses that we're putting in that we need anyway. We're not just going out to buy things to have expenses, right? They're things that we still need for the infrastructure to grow the company, but it's offsetting. It's basically investments into the company and things that the company needs to lower tax. So like at the end of last year, when did you start with us? I forgot.
3 months ago.
So the first vehicle we bought for Prime Painters, I was hustling at the end of the year to buy it. Because Prime Painters was going to give me, I don't know the actual number, just say it was going to give me $50,000 of taxable income that if it was still there. Well, we needed a vehicle anyway. So we bought the vehicle, and the vehicle we were able to depreciate right away, take the full expense against it. It lowered the taxable income. So it saved me a few handfuls of thousands of dollars in taxes, while my company got something it needed to grow. So that's the power of having corporations, and once again, kind of the cash flow, right, going through. Now the goal, does that all make sense?
Yeah.
A little bit?
Yeah.
Now you're still going to pick up. So whatever your company were to make, like Maudine's Amazon flipping LLC, whatever that company makes and has left at the end of the year, that will still get picked up here. But you can reduce that. Like if you just didn't have a LLC doing that, and let's say you sold $15,000 worth of stuff and you didn't track your expenses, the $15,000 is what's going to go here if you report it all. But if you have expenses to go against it, then, and it could be $7,500 of expenses, only $7,500 is showing up on that. So it's after, it's after some of those business expenses. So the goal is obviously to pay more in capital gains. The goal is to have more companies working for you. The goal is to pay more in capital gains. How you're doing that, right, is you still got to earn it. This is why, even though the earned income is your trading time for dollars, it's where it gets hit the hardest by taxes by far, you still need it, because to get started into earning capital gains, you're going to need capital working for you. Right? Now, income type, right? Earned income, earning potential on earned income also is limited. Because once again, you only have so much time that during your days, during your months, during your years, that you can work to make money. Capital gains is unlimited. So even someone that's super wealthy that, all right, Patrick Mahomes, $50 million a year or whatever, right? That's earned income, right? So he's getting dinged. But if now Patrick is smart, he's going to take the $50 million, and after the 37% in taxes, he's going to invest it so that going forward, that money is still working, paying cash flow, and when those investments sell, they're now sold at capital gains at 20%. Because he could have, by the time he's done playing, he could have $100 million, $200 million of assets. If those assets then appreciate to $600 million over his life, and he sells them, the $400 million gain it's not going to be at the 37%. It's going to be at the 20%, unless Biden changes that, which is probably going to be changed. This number could change to 25, 28% in the coming months, right? But capital gains has kind of always fluctuated a little bit. Capital gains has always kind of gone up and gone down, and depending on who's in office, right? And so My big thing is the whole government thinks, oh, okay, well, we're going to raise the capital gains. I think you will have less people selling. And they'll wait 8 years. They'll wait for, now if they were already close and their business plan might be done, expiring, whatever, some people could be forced to sell whatever. But looking at certain things, like looking at certain properties we have, there's a likelihood I would wait to see if that capital gains rate comes back down when a Republican is back in office, if it gets changed, right? There's one other thing that I was going to hit there. So the other thing with taxes, right, and when you get money working for you, is real estate, for example. The first 3 years you own real estate, you could be getting cash sent to you every single month. You could get, we send our investors $2,000 a month checks, $4,000 a month checks. And if they're getting that check from a property we've only had for 12 months, 24 months, 36 months, sometimes 48 months, they actually will pay $0 on that cash that they're being sent. Because once again, the real estate is a corporation. It brings money in via rents, but then it has to pay utilities, it has to pay insurance, it has to pay the interest on the mortgage, which is deductible. Deductible meaning it lowers your taxable income. The real estate's taxable income, right? The depreciation that's there, the maintenance tech that works on site, the property manager that works on site, all of those expenses are written off. And then you have interest on the loan that's written off against the income. And then you have depreciation. Depreciation is not an actual cash event. I don't have any cash going out, but theoretically they're saying, hey, this building over 30 years is going to depreciate. It's going to go down in value from a standpoint of like you're going to have to replace, that refrigerator that's in there, it's going to go down in value. The carpet is going to go down in value because you're going to have to replace it at some point. It depreciates over time. You get to take depreciation starting year one right away, and that depreciation is an expense that shows up against your taxable income, lowering your taxable income, even though you didn't have an expense, you didn't have a cash outflow for it. So utilities. Utilities are deductible. They lower your taxable income, but you have actual money, cash going out of your pocket to pay the energy company. With depreciation, you get that very big expense. It's one of the biggest expenses. It can be 6 figures, 7 figures in some of these deals we're doing a year. You get that big expense that's going to actually take your taxable income to be well into the negatives. $600,000, $1 million, $50,000 into the red, into the negatives, even though you're making money every month, and you don't have cash going out for it. So that's the power of starting to get your money to work for you, because not only are you getting those benefits, when you go to sell it, it's going to be capital gains. So how do you go about doing this? How do you go about getting more? And once again, this is conceptual. Like, we don't need to go in. I don't understand all of the things down into the weeds. That's what the accounting department is for. You need to understand how it works at a big picture. I'm a great example of I do not know all of the details. That is why on the last episode, we talked about having a team, because you need a team of people. I don't know how this works at the most granular level, right? I can understand and read my tax return. I can understand 45, 65% of it. There's parts of it I don't understand, and that's why I have to have a team and a firm that help me do that so that they're done correctly, so I'm not going to end up in jail. Because I will push the envelope. I will push as far as I can. But then when they say, hey, you shouldn't be doing that, okay, well, we don't do it. I'm not trying to go to jail over something. Right? So I hope you notice too how each episode builds on each other, and it's like, okay, I don't know how to do all this. That's why this is just about conceptual. You don't have to know all of this stuff down to a T, down to the most finite little detail, because you should have a team doing that for you. And yes, you're still in the loop and you know what's going on, and they should be trying to teach you along the way, and you should be willing to learn along the way, but don't think you need to know all this stuff before you start. So how do you do this? Save your earned income with the intentions to invest it. So going back to what they were saying on Fox Business this morning about, they're talking about everyone, sharing, 65% of parents are now, it used to be 45%, but now today it's 65% of parents are talking about money with their kids. But I think the information is wrong. Because my number one bullet point is not save. It says save, but it says save your earned income with the intentions of investing it. And that doesn't mean invested in a 401k that you can't see, that you can't touch for 20, 30, 40, 50 more years, or an IRA or whatever. I'm talking about investing in something that's cash flow producing, a real asset that's cash flow producing that you're going to get benefits from right away from a cash flow standpoint. Why lock up your money and you can't get a benefit from it? Number two, invest the amount you have saved. So number one, you're going to save the earned income with the intentions to invest it in cash flow producing assets. Then number two, you're going to actually go out and invest the amount you have saved. You're not going to go blow it on something else that might look cool. You're not going to go blow it on a depreciating asset or a car. Once that amount is invested, even once the asset that is invested in sells, you need to make sure that that initial amount you invested always keeps working for you. Anytime I send $100,000, $250,000, $500,000 out into an investment, that amount of money will be working for me forever, paying me cash flow, even if the current assets it is in right now sells, because when it sells, I'll get that principal back, and I'm going to put that principal, at least that principal, to work. But what I've been doing over the last 10 years is I'll put that initial principal back to work on top of all of the profits over that it gave me. Put it all to work. And that will lead you to start paying more in capital gains going forward. And not next year, not 2 years, not 3 years, but well, it could be 2 years, it could be 3 years, but for sure 4 years, 5 years, 6 years, 7 years, 8 years, 9 years, 10 years. You know, the goal is 10 years from now you're paying way more in capital gains than you are in earned income. And sometimes in this game, if you're in the right trade and doing the right things, your income can be offset to the point where you're paying zero on the tax line. Full-time real estate guys know what I'm talking about. They don't have to pay anything a lot of years. All right, this is straight out of, so people are also talking to me a lot about books to read, right? One of the top 5 ones is Rich Dad, Poor Dad. This came right out of Rich Dad, Poor Dad, right? And so you have the poor, you have the middle class, you have the rich. You've got the income statements, and you've got the balance sheets. Poor, they got the income coming in where they're working, you know, it doesn't even matter where they're working at. This by the way, this poor person, when you start to build wealth, the definition of poor, middle class, and rich become very different. Because I know people that make $400,000 a year that are poor. And I know people that make, you know, $40,000 a year that are on their way to being rich or already are rich. The difference is these arrows and what's going on. And so if you've read the book and not really completely understood what all these graphs mean in that book, well, maybe I can teach you something today. Maybe I can help you understand that. Poor have an income come in, and it could be $8 an hour. It could be $2 an hour plus tips as a waitress. It could be $40,000 a year salary. This could be an NFL player. This could be a guy that makes $2 million a year, and he's still freaking dirt poor because he's got taxes that we just talked about. He's got 37% going to taxes. He's got rent or a mortgage. The mortgage being the house he lives in. That's the big thing too. This is why your house that you live in, if it's the biggest investment you have, you're in trouble, and why it's not a true investment, because every single month it's coming in and it's going out. Right? That guy playing the NFL, he's paying for food, and you know what? I heard the rookies, they got to go buy like the whole team meals, right? There's a $50,000 meal right there. They got a cool new whip and some cool new chains and clothes, right? So they can be dirt poor. This isn't a how much do you make, it's a how much can you make, keep, and then get working for you game, right?
How many NFL players that are retired, they end up broke, or people that won the lottery?
There's so many. Yeah, this is the person that won the $300 million lottery 12 years ago that is now broke because they had the income come in and their expenses were nothing. They had no assets, and they maybe had liabilities. They bought the car, they bought their house, whatever, right? They started to loan against it. Their liability stack got huge, and the assets stayed zero. And that's why there's a couple NFL players I talk to right now, and it's like, dude, you can be making the salary you're making right now if you, right now, have this and have the rent be as small as possible, the food be as small as possible, the transportation be as small as possible. Don't go buy a house and have your rent be as small as possible. And then that way, what is left on the way out here, you have plenty left to invest, and the cash can come down here, invest, and you start building your asset column. And now all of a sudden, your assets over here become like the rich and wealthy, where the assets are paying you your income, which then can pay your expenses. Because if athletes don't do this, or if they are like this and they don't build up the asset column, it doesn't matter. That spigot gets turned off one day and they realize that, oh man, I'm not making the same amount. But the crazy thing is you can start to do this even at making $40,000 a year, making $20,000, like $30,000, $40,000, $50,000, $60,000, right? And I'll get there in a second. The middle class, they have a salary, and then because now they're middle class, so now they get credit, and so they start to add up liabilities. And the liabilities, the mortgage, the car loans, the credit card debt, the school loans, their income comes in, because that income might be $60,000, $80,000, $100,000, $200,000. They start to get credit, and they start to get, they borrow, they put frickin' 5% down on a house. They get a cool Audi. They have 4 credit cards, and none of those credit cards are for business purposes. Those credit cards are accruing interest. This is the stuff Dave Ramsey's worried about. And I agree with Dave, where credit card, you shouldn't have the bad credit card debt being, stuff that's not actually, if you're paying credit card interest, it's bad credit card debt, and that's where you don't want it. Unless you're able to take that credit, like I have done, and pay interest on it, but get the money working. I've taken loans from credit card companies at 6%, 7% to get as much as I can to put into deals, and then I just pay it down with the cash flow that it's paying me. I don't care if it's 7%, 8%. The deal's paying me 12%. School loans, right? So now the middle class, they're getting a salary. It doesn't go right to their expenses. They rack up the liabilities. The liabilities now is what gets a chokehold on them, and now their cash goes out, and the expenses to cover the liabilities. Makes sense, Martin?
Yeah.
The rich, they start, this is how I started, was salary. So there should be another arrow here, in my opinion. There should be another arrow coming in, because they still at one point, or even still today, they have a salary, or they're working hourly, or whatever, and they have the money come in, but then they put as much of that money as possible down here into assets. And then the assets will get the liabilities, so the assets will pay off. So again, this, in my opinion, this arrow should change. The income will come in up here. You invest them into assets. Now the assets, the other person's rent is paying for any liability that's against it. Then there's cash left that will then come up to your income, which then can go pay your personal expenses. That's cash flow, what I talked about right there. And then here's a little bit what I was talking about before, where there's a corporation income statement, right? So if you start a corporation, that corporation has its own income expenses. It's got its income, it's got its expenses, and then it's got its taxable income, right? So if you have your personal statement and your personal balance sheet, and your personal income statement has a salary on it, and you invest that salary down here into assets to get more buildings and properties, right? Each building and each property will have its own income statement and expense statement. Those assets will cover, they'll get income. That income will cover the assets expenses, like the insurance, like the mortgage interest, like the utilities. And then there's going to be money left that will come to you. And this is what I'm talking about right here, where it's got expenses showing on the corporate. There's things that in your personal life you can move legally over to the company's income statement. So now these expenses become write-offs versus sitting in your personal income statement. These personal expenses do not lower your taxable income.
Feels illegal.
It's not illegal. But that's why you do need a legit, you can't just, I mean, you know, you probably have, when you set up an LLC, you probably have a span of 1 to 2 years to like, okay, he's actually got $6,000 coming in here. He's got $10,000 coming in. If you just have a corporation, just one single corporation, and you're an employee and you don't have anything else, they might catch on to this and this might be an issue. But now if you're actually growing that business and you're using those things for that business, yeah, it's 100% legal. My cell phone, I mean, I use this, you see how much I'm on the phone, right? But this also handles when I talk to my grandma. This also handles when I talk to my sister about non-business stuff. This also when I text my friend to let's go golfing, I use this one. But the company's paying for it because, 85, 95% of what I'm doing with this is, probably actually more like 99.99% of what I'm doing with this is all for the company. So it sits here, company pays for it, lowers the taxable income. I do not have a personal cell phone expense each month going out. I want as little in my personal name as possible. I want like nothing in my personal name. I want to own assets that then they take care of all this shit. I don't want a car in my name. I don't have a car in my name. The vehicle out there is Spaulding Group.
How did you buy your house?
It's not in my name.
How did you?
It's not in my name. I want as little as possible in my name. I want to control everything, but I don't want to actually own anything personally, other than the actual. I want to be able to control it. I don't need to I don't need to own it.
How's your house related to your business?
I'm real estate. I'm in real estate. So now my actual interest payments on my house are not being written off, right? They're not being written off. Now, the YouTube TV that we use there, I use that YouTube TV all the time in my office. I watch Fox Business, I watch all that stuff over lunch. That's what I've got on in there. Anytime I'm eating, people hear stuff going on my computer, I got Fox Business, whatever, right? And so that's for office purposes. I hardly watch any, so that's, I don't have that personally. So yes, there's some rule breakers because you don't want to get caught up in trouble, right? You don't want to do the wrong thing. So there are some rule breakers, but a vast majority of things, when you have a corporation, a lot of them are in that corporation. My vehicle, for example, 98% of what I do with my vehicle is business related. I would put on, if I didn't do what I do, I would probably put on, I don't know, I probably drive 40,000 miles a year. And if it weren't for doing what I do and for the businesses, it would probably be more like, I'd probably drive like, I don't know, I hardly drive at all for not business stuff. So I couldn't even put a number on it. Maybe 4,000 miles a year. I don't know, I hardly drive at all other than that for the business. I don't know how many miles you put on your car.
I mean, it's mostly work-related.
Work-related? Yeah, right. Going to and from work, I mean, that's the big one. So yes, there's some rule breakers, and that's once again why I said from a high-level conceptual standpoint, that's what this is about. Because again, I try to be as aggressive as possible in this, but that's why I have a team of accountants that pull the reins and say, all right, this we got to change, can't do that, because that you can get in trouble for. I'm like, well, I don't know, I can justify it in my mind, but he's like, well, the IRS doesn't look that way. Okay, let's change it then. Let's do it the right way. Let's do what you say on that one. But people that don't have a team, because they think they can do everything alone, also might be why they're scared to take on some of this stuff. Because like, well, I don't want to do the wrong thing. See, I'm looking to push the envelope so far that I need other people on my team pulling me back, saying, no, you can't do that. Because I know a lot of the people that I'm working with are a lot more conservative. They don't want me to get in trouble. I don't want to get in trouble. They know I don't want to get in trouble. They know I'm not trying to be intentionally breaking the law. But I want them to have to pull me back. I should be the one pushing the envelope. Why the rich get richer. So this is what I was talking about before, actually. They keep their expenses as minimal as possible. This down arrow doesn't have the money going anywhere. It's just saying, hey, shrink. And that's why this box is so small. Shrink the expenses. Have your income go up, but have it be from the assets, right? And this is ultimately how you're going to get to the standpoint about what we started this whole thing on is taxes and paying the least amount of taxes possible. They have their income, their personal expenses. What's left goes to assets. If you're really, really good, you're actually going to have personal income. You're going to skip the expenses. It's going to all go right to assets. Assets are going to grow bigger. As they grow bigger, the income's going to come up. And once you get income from assets, cash flow, now you can have your expenses and then go to assets. And your liabilities are pretty small. And these are personal liabilities, right? Because you're going to have liabilities with these assets. You know, your real estate's going to come with a mortgage. You know, you might get a truck in the company that has a loan on it. That's fine. But this is your personal balance sheet right here. You want as many cash flow producing assets as possible. Your personal residence does not fit here. You know why? Because there's no arrow going up to income on your personal residence. Your personal liabilities, like I said before, you personally don't want to own anything. You want to control it. You want to control it all, but have zero in your name. That's the ideal. Does it ever happen perfectly where it's zero? No. But to the best of your ability, that's what you want.
And if you go bankrupt, like another world, like dimension, if you go bankrupt, you get in trouble because it's not on your name, it's on your company's name. Well,
right. That's the idea. This will keep you from, like, if one of your companies go under, your company goes under. Now, you might have signed off personally on some of that stuff, which you still might, if your company goes under, there still might be some liabilities there, but not every single liability you're going to have to cover. The goal is, if you don't have anything personally, it's hard for you to go personally bankrupt. If something goes bankrupt, it's one of the companies that you control, and now you lose control, or now it just goes away, or whatever, right? So if you do it right, like we got this real estate. If the real estate goes wrong, they're not coming after me for $30 million of mortgages. They're just going to take the property back. They're not coming after me unless I break the law. If I break the law, they can do that. They can come after me for the amount. If I don't break the law, if it's truly because of performance, something happens in the world, whatever, they're going to take the asset back. And then the loan would go away. And then the asset would go away, that one's no longer paying me. And if they'd taken it back, it probably no longer was paying me anyways. So that's pretty much that. But this right here, understanding cash flow, understanding assets and corporations, that is how you're going to start to get from, earned income to then having a corporation with your earned income that will help lower some of those taxes, to then save more, to then invest more, to then get to capital gains rate. And the more that you have invested, once again, going back to what we said before, when you invest in things, now those companies have expenses that lower the taxable income amount, and you have depreciation, and you have interest and all that stuff. You're going to have expenses that happen first before you're taxed. Versus getting taxed, having less money, then having to pay your expenses. That makes sense?
Yeah.
So, hope this episode was helpful. Hope it, gave you some insight, gave you some thoughts. This is truly how I think about the game. Definitely appreciate you guys joining. 26th episode of the Justin Spaulding Show. Please, if you have not yet, please subscribe to our YouTube channel. Share us with other people who would get value out of this. We've had a lot of people sharing lately, and that means a lot. And feel free to shoot me questions. I might not get back to you right away, but we'll feature them in the show. I might make a full episode about it like we did here. And let me know what you liked about this episode, hated about this episode, want cleared up in this episode, because we can always go into it more later. Thank you guys. Have a great summer weekend, and we'll talk to you next week.